New Entertainment Tech Incorporated, a video game manufacturer, incurred the following costs during the current year: copyright purchase from Jackson, game development expenses paid to employees as a part of salary is basically an expense, design cost of trademarks for internally developed games, and expenses to retain and improve relationship with the customer. This is clearly an expense. So there are two items that might need to be considered. What is the amount that should be shown as an intangible asset for the year? Now, the copyright that you purchased for $25,000, this clearly is an investment in an intangible. This is an intangible asset. And secondly, the design cost, this is clearly not the research and development. Please remember, research and development cost under the US GAAP, both must be expensed, but development cost can be capitalized if certain conditions are met. So this design cost for trademark for internally developed games is being an asset is being created, asset is being generated. It's other than the research and development. So these two costs, 25 and 11, they are the cost that you can capitalize and show as an asset, as an intangible asset. Next. This is a tricky question. Division Corporation has 20,000 shares of 5 participating 9% cumulative preferred stock. 20,000 shares of 5 each, they get 9% dividend, and 100,000 $2 common stock. Let us write these down. We have 20 times 5, we have $100,000 worth of preferred stock, and 2 times 100, that is $200,000 worth of common stock. It says on July 1st, so if you see the proportion, the relative proportion of capitalization, 100, 200, 300, 100 by 3, 200 by 3, so you will see it is effectively 33.33% of the total equity, and this is 66.66% of total equity. Okay. Now what it says, on July 1st, the board of directors declared, please remember these cumulative stocks are participating. They participate in profits other than the fixed dividend they get. So on July 1st, the board of directors of this company declared a 30,000 dividend at the time the common stock was selling for this and preferred stock was selling for this. We don't know and we don't need this at all. The total dividends paid to each class of stocks on the payment date was, first of all, you have 9% dividend rate at preferred stock, 9% of 100,000, that is 9,000. Since we have not been given, what happened? Just a minute. $9,000. We have not been given any clear indication what exactly is the dividend for the common stock, right? So since we are talking about the participative preferred stock, 9% rate is being used for this participating common stock. 9% would be used for common stock as well. 9% of 200,000 is going to be 18,000. So same percentage is applicable for common and preferred stock. If you see the total dividends we have is 9 and 18, it is $27,000, whereas the dividend declared was 30. The additional dividend 3,000 again will be split in proportion to the capital composition of 33 and 66. If you do 3,000, 33.33% will give you 1,000, and 3,000, 66.6% will give you 2,000. It means based upon the cumulative percentage, $10,000 dividend would be given to the preferred stock, and 20,000 dividend would be given to the common stockholders. So it's going to be 10 and 20, and this matches with your option. There is no such question in any software, in Wiley or Hawk or Gleim, because we have never come across any question like this where we have to use the proportion of capital in the equity. Nonetheless, this is it. Consider the statements below regarding accounting classification for leases under the US GAAP and under the IFRS. Which of the statement is correct? First, IFRS only allows classification of lease as an operating lease. Wrong. Operating lease classification is available both in IFRS and US GAAP. US GAAP does not allow classification of lease by the lessee as a finance lease. Wrong. This classification is possible. It is there. Finance lease is available both in IFRS and US GAAP. US GAAP allows for classification of lease as a capital lease. This term is no longer used. Capital lease word is no longer used under the IFRS or US GAAP. So, statement 1, 2, 3 are wrong. What about statement 4? US GAAP allows classification of lease by the lessor as either a sale type lease, direct financing lease or operating lease. This is true. This is true for a lessor. There are 3 classifications at least. This is what we should know, not the accounting treatment of leases for a lessor. Just what types of leases are available for lessor. So these are the sales type, direct financing and operating lease. This is correct. Fourth one is the right option, and that makes D to be the right option. Next. Topper Company began operations during the current year and experienced the following events. What is needed? In Topper's 31st December balance sheet, accumulated other comprehensive income would be. First of all, we know OCI has 4 components in your CMA syllabus. Foreign currency translation, available for sale, debt security gain and loss. Then we have effective portion of cash flow hedge and pension adjustments. These are 4 elements there. So it says unrealized holding gain from trading debt. Wrong. This goes to income statement, not in OCI. Realized gain from selling available for sale security. Realized gain even on available for sale debt security. Realized, it goes to income statement. We know that in detail. We've done it many times. Unrealized holding gains. Unrealized holding gains for available for sale debt security. Yes, that is something we report in other comprehensive income. So yes, there is a gain of $20,000, and since the tax impact is to be shown as well, so tax at the rate of 30% on 20 is going to be 6,000. So net of tax OCI would be credited with 14,000. So that would make B to be the correct option. Next. When the total consideration for the contract with the multiple embedded obligations reflect a discount, maybe you're offering obligation A, B, C, D in a bundle at a discounted price of 90,000, whereas the separate value of ABCD contract is a sum of 100,000. So this 10% discount, what should we do with it? This 10% discount. So the question says when the total consideration, total amount for a contract with multiple embedded obligation ABCD reflect a discount, the most appropriate way to assign that discount is to do what? Is to assign it equally across obligations? No. If you remember the question we did, a refrigerator sells for 45,000, and if the refrigerator is sold separately, it sells for 40, and if we sell what you call that was I think warranty, it sells for 10,000. So collectively we sell it for 45. So you remember we split this 20/80. So you need to split not equally based upon the relative amount. Assign it to the obligation with the highest standalone price. Meaning if let's say D has the highest price in the contract, so all of it should be charged to D. This is again wrong. Allocate it proportionally to all obligations. Remember the same example. Refrigerator and warranty being sold at 45, and we use this proportion 20/80 to split the obligation price. So you allocate proportionally. This is the right thing we did in that question. That's the right option. Next. Ryan Brother Corporation has the following differences related to its year 1 financial and tax statements. Tax depreciation exceeds financial depreciation by 10,000. When you are charging more depreciation on tax basis, it means your taxable income will be lower. You will have to pay less tax now, but in the future you will have to pay more tax. Remember, whenever your accounting profit is more than your taxable profit, you will be paying less tax now, but in the future you will have to pay more tax. Under such circumstances, it results in deferred tax liability. How do we calculate? Take the depreciation amount multiplied with tax rate. It's going to be 3,000 deferred tax liability. Why liability? Because you are charging a higher depreciation in tax-based accounting. Tax-based profit will be lower, means you will be paying lower tax now, but in the future you will have to pay more. So this is what results in deferred tax liability. What about item B? Ryan paid life insurance premium of $12,000 on a policy where the company is the beneficiary. It is not mentioned in your textbook, but remember, any life insurance premium charged as an expense in your income statement is an inadmissible or non-deductible expense. It will never be an allowed expense. It's a permanent difference, and remember, any permanent difference, it does not come in our calculation of deferred tax asset or deferred tax liability. So it is to be ignored. So only this element is what is relevant. Ryan will record a deferred tax liability of $3,000 representing $10,000 differential of depreciation under the tax accounting and under the financial accounting. The balance in accumulated other comprehensive income from one period to the next period will change as a result of four elements. Number one, foreign currency translation gain and loss. 2, available for sale debt security gain and loss. 3, any gain and loss on effective portion of cash flow hedge. What it is? Part 2, Section B, CMA. And 4th, any gain and loss on pension plans. We discussed these. So these are the four elements that will affect your OCI. Net income only, it affects only income statement. Retained earning, income statement. Net income and other comprehensive income, this collectively is called the comprehensive income. Only other comprehensive income out of these four, they will be reflected in your accumulated other comprehensive income, which is shown where? It is shown in the statement of changes in equity, right? So that makes C to be the correct option. Other comprehensive income, all transactions affecting this will be accumulated in the SOCE under the head accumulated other comprehensive income. Next, under the IFRS, which of the following would be included in the income from continuing operations on the income statement? A large loss from foreign currency transaction, not translation. Yes, it would be reported as a part of continuing operations. A union strike that shuts down operations for 3 months and then after it was again continuing. So it is a continuing operation item. A foreign government takes possession of the company's only plant. It doesn't mean the business is discontinuing. It still will be reported as a part of continuing operation. We have no indication that the business is closed or the segment is closed. And a damage to factory due to an earthquake in an area that had not previously experienced earthquakes. Despite that, it would be reported as a part of continuing operation. None of these items is a discontinuing operation, so all of these would be reported as a regular, not regular, as a component of your income from continuing operation. D is the right option. Next, which of the following transactions may result in a debit to the additional paid in capital? Interesting question. Debit to additional paid in capital or additional contributed capital or share premium in our part of the world. Premium on capital stock issued. When you issue capital stock at premium more than the par of the stock, the entry you make is you debit cash, you credit common stock, you credit additional paid in capital. So here it is being credited. We want to see the one where the additional paid in capital is being debited. Mind the word debit. Let me specifically highlight debit to the additional paid in capital. Okay, let us see option C first. Key B for the later discussion. Receipt of equipment in exchange for shares. You gave share to someone and you got an asset out of it. So the entry you make, you debit the machinery or the asset, you credit the common stock and you credit your additional paid in capital. Again, here is being credited. Conversion of bonds into common stock, convertible bond. The entry you make is you debit bond liability, you credit common stock, you credit additional paid in capital. So you can see additional paid in capital is being credited in A, C and D. What about B? What about B? Sale of treasury stock below cost. You are selling your treasury stock which you bought for maybe $12. You are selling this treasury stock for $9, less than the price you paid for it. So what you're going to do in that case? In this case, you are going to debit your bank, credit your treasury stock. Any difference between the price you paid versus the price you're getting will be debited to the additional paid in capital. Remember, if you sold a stock for 9, the stock which you bought for 12, your own stock, the difference is debited to additional paid in capital. And if there is no balance available in additional paid in capital, where you're going to debit it? So if there is no balance available in additional paid in capital, then this differential should be debited to the retained earning. Absolutely right. So we got the answer. This is where you're going to debit the additional paid in capital. Next, which of the following statements is true regarding the calculation of comprehensive income? Looking for the true statement. Coming in the reverse order. It will include cash dividends. There is no cash dividend in comprehensive income. And exclude stock dividend, yes, stock dividend is excluded. It will exclude cash dividends, yes, and include stock dividend, wrong. Comprehensive income has no transaction involving shares, totally wrong. Because comprehensive income is the sum of income statement and OCI has those 4 components that we have just discussed a couple of times. So it will exclude losses on discontinued operation. No, it will include losses on discontinued operation because this is a part of income statement. So B, C, D are wrong. What about A? It will include losses on discontinued operation as a part of income statement. And income statement is a part of comprehensive income. So that makes A to be the correct option. Next. According to FASB, that is US based, and ISP, that issues IFRS, conceptual framework, the primary users of the financial reports include all of the following except. Investors are primary users, those who have purchased the share. Creditors, those who have provided you the goods and services on credit. And lenders, those who have provided you money. All of these have the direct financial interest. So they are the primary users. Whereas the regulators like SEC, Securities and Exchange Commission in the US, SECP, Security Exchange Commission of Pakistan, then we have SCBI, Security Exchange Board of India. These are all regulators. They are also interested in your financial statement, but they are not the primary users. They do not have any financial interest of their own. So that makes D to be the correct option. Then, Carrington Company is trying to determine how to account for the financing of receivables with recourse. Receivable with recourse means you have sold your receivable, but if any bad debt occurs, the financing company will come back to you. These are the receivables factoring, I'm sure you know. Carrington knows the transaction must be recorded as either a sale or as a secured borrowing. It will be considered sale if complete control is given. You no longer hold control on your receivable. But if you still exercise control, it will be considered as a secured borrowing where you have given your account receivable as a collateral. Let us discuss. You still, as a transferor, has a right to pledge or exchange the receivables. If you still have the right to pledge, you still own them. You still own the receivables, so it will be considered as a secured borrowing. Right? It's not a sale. Next, the transferor, you still maintain the control over the receivables and asset. It will still be considered as a secured borrowing. The transferor, that is you, and the creditor have the access to transferred asset. You still have the access to your asset. So ABC reflect a secured borrowing because you have the control. You have the control to pledge, right? You have the access. All these represent that it is a secured borrowing. But when you totally give up control on your receivables, you give up the control on your asset, that is what you call a sale. Under US GAAP, which element is required to account for the transaction to be classified as a sale? If the seller, the transferor of the receivable, surrenders the control of assets. You no longer control your receivables. In this case, it will be considered as a sale.